Financial models serve as a virtual representation of a business. Their main purpose is to build a reasonable proxy of the future and support informed business decisions. The best way to assess the profitability of a company or a project is by examining the financials it is expected to produce in the future. A financial model is a perfect vehicle that would allow us to do that. Financial models are more than just spreadsheets with calculations. We can talk about a model when calculations are logically interrelated and there are clear relationships between the parts of the model. Just to give you an example, if an Excel sheet multiplies a firm's debt by the interest rate it pays and obtains the amount of interest expense it should pay at the end of the year, we can't say this is a financial model. It is just a calculation, right? Now, imagine the amount of outstanding debt comes from a source sheet, and the interest expense feeds a P&L statement and a cash flow, which determine the debt that will be repaid, affecting the firm's balance sheet. Well then, that's the type of logical flow and reasoning we would expect to see in a financial model. Probably the greatest benefit of financial modeling is scenario building. It allows executives to play with a company or project's numbers and hypothesize different developments. They can easily see what will happen if things go south, how much cash is necessary to run the business, and when is the low point where the firm will start burning cash. In today's environment, financial modeling is one of the main pillars of corporate finance and business decision-making. It is used on Wall Street and Main Street, and it pays off to be a solid modeler. In our previous lesson, we partially answered the question, why use financial models? And we said this is the preferred tool of decision-makers when they must decide whether a project is feasible. Right. Let's provide a practical example that will shed more light on this idea. Imagine the following situation. A company's CFO holds an earnings call and announces his company expects EBITDA to improve by $250 million over the next 5 years. The reason is faster growth of sales. That's great. Investors are always pleased to hear that. But analysts could ask, how did you come up with this figure? Are you assuming a higher cost of production too? Or does it stay flat? What about OPEX? Revenues will grow and the volume of work will increase. Did you plan accordingly? Is your firm prepared to invest in working capital? And what is going to be the cash impact of the improvement in EBITDA? These are valid questions, and their answers are connected. Think of a company as a living organism. All its parts function together and need each other. Therefore, we need a holistic approach, a 360-degree view that allows us to observe the impact deriving from the change of individual parameters. And that's precisely where financial modeling comes in play. It is a tool that shows the full picture. It allows us to see the development of a firm's revenues, costs, assets, liabilities, and the cash impact of each of these items. When presented with an investment opportunity, financiers are interested in learning about two things: the idea and the financial model that's been prepared by the team asking for financing. The financial model reveals several important aspects. When is the firm planning to break even? How realistic are founders' expectations? How much is the estimated market potential? What kind of expenses are planned over the next few years? How much cash does the firm need before it takes its product to market? These are some questions that are answered in a financial model, and it is easy to understand why financial models are decision-makers' favorite tool.